All right, here we go. You're in the right place. Put the banner up. Put myself in the screen. We're getting ready. Oh, yeah. Oh, yeah. Hey there. I'm Mitch Goldberg. It's 4:30. So if you see me live, set your watch to it. You know it's 4:30. This is my live stream. Be the boss of your money. We talk about personal finance, investing, and I help you answer questions like, well, should I put more money into this? What should I invest in now? I'm pretty inspired right now because I had a conversation with someone who I'm gonna say is a friend, new friend, and just a very inspiring individual. We talked about a couple of things about how this person has overcome obstacles. Um, we'll call it the second half of life, and has done very well for herself. And it's just such a kind person. Anyway, yeah, that's the beauty of business and networking. You meet people like that, right? So anyway, let's talk about the market today. It was an ugly day. Not so much because the market didn't crack or anything today, but I'll just show you what I mean. Let me prop myself up in the screen and make this screen a little bit bigger so you could see it. There we go. All right. The Dow is up a point. So you might think, well, okay, it's not the worst thing. I mean, up is up. But it was up 450 points earlier in the day, like right out of the chute, even last night at about midnight. And I know this because I'm up till like 1 or 2 in the morning every night. And I look at the futures, and no, I'm not up. Looking at the futures is not what's keeping me awake. It's just a general insomnia that I'm going through right now. And it is, the Dow is indicated to be up a couple hundred points, 177 at like 12. Then as the night progressed, we got into early morning up 300. So anyway, when you have a 450 point up day and you give it all back at the end of the day, it's really, it's just not a good close. I'd rather see the Dow down 450 points and close flat than be up 450 points and close flat. Continuing the decline in the NASDAQ, going further into bear market territory, meaning 20% or more from an all-time high. You have the NASDAQ down 262 points, down 2%. See that? Okay. Let me see. Down 2%. That's a pretty rough day. 1% moves definitely get my attention. 2% moves, you have my focus. Okay. S&P 500 is in between, and again, it's just the big tech stocks just keep getting pounded, and people keep jumping into them, saying, "Oh, it's a buy now. It's a buy now." Now you definitely have to buy Meta, which is Facebook. You definitely have to buy Amazon. Maybe, maybe not. I could tell you that whole move that Amazon had after it announced its 24-inch stock split, uh, it's pretty much evaporated. Gold was finally over 2,000, cannot hold 2,000. And I think the story of the day is oil. Um, Oil tanked today, down 6%. It tanked one day last week on Thursday. One of the things we talked about in the live stream last week was taking profits in oil stocks, because when they go parabolic and the chart looks like a hockey stick, you take some gains, you take something off the table. That's what we spoke about. And I caught some shit from people. I don't want to overplay it. I mean, I got a little bit of pushback in some circles. Why are we holding on to energy stocks? Oil stocks are a thing of the past. Nobody's going to want oil stocks. We're all going to, electrified cars. Nobody wants oil. And my thinking is, it's an out of favor sector, good dividends. The industry has gotten not just disciplined, not just religious, but zealous about financial discipline, not over drilling and spending money on all kinds of wildcat projects. That, by the way, is the reason why you're not seeing the energy sector pump as much oil. It's because energy companies realize that they could make more with less. They could make a lot more money by spending less and pumping less oil. And they spend less on oil exploration. So that's why we're having an energy supply issue here in the United States. People go, "Oh, they just pump more oil." Well, it takes time to drill a hole and make it suitable to pump oil and do all the things and take all the steps that you have to take. So energy companies have learned how to make more with less, and that's the reason why energy is in short supply right now in the United States. It has nothing to do with Russia. Energy prices have been going up all year. Well, we're only in March, but since last year, energy prices have been going up also. So I just want to put that in perspective. So, but the story of the day though is how oil is down $7 over 6% today. And I'd say the other big story of the day is this: the 10-year treasury, okay, at 2.14%. That was just at like 1.6s, 1.7s a week ago. And we'd been, the treasury was getting up to about 2% earlier this year. It came right down because of a flight to safety. Investors sold stocks and went into treasuries. In spite of the inflation figures, the very high inflation figures we're seeing. And the inflation figures are high. There's no way to sugarcoat that. They're just, very, very high. Ah, boy. So had it not been for the Ukraine-Russia war, we would probably see the 10-year easily in the twos this whole year, but probably even higher than it is now. And when I say higher, where it's impossible to say where it would have been had it not been for a war. But I'll say my own guesstimate would be around 2.5%. So it should even be higher than that with inflation running, 6-7% plus. It's expected to moderate the inflation, but we keep saying that every quarter, and eventually you have to start to acknowledge that maybe it's not going to moderate like you think, right? But one day it's going to moderate. You'll see. One day. All right. And the VIX was up a little bit, up a point, 31. No great shakes on the VIX. The VIX has been solidly over 30, and that's going to pressure the market. And let's take a look at the Russell 2000 small cap. The Russ 2K off almost 2%. So it's a tough day in small cap stocks. Okay. So the question is, why wouldn't the market go up if oil was down so much? And that's the relationship we've been seeing. When oil goes down, stocks go up. Oil goes up, stocks go down. So if oil goes up, it hurts the economy. It takes discretionary spending out of the economy, because if you're going to put more money into your gas tank, it's less money that you're going to have to spend on other things in life. That's just not great for the economy. It's like a big tax on the American public. But today, oil went down and stocks went down. So it just was not such a great day. And I think if oil does come down, it doesn't really first of all, oil's down short term. I don't think investors are really buying into it that oil's going to stay down. I think the feeling is that oil could come down a little bit, but it'll probably go back up again. That's one part of it. The other thing, though, is the Federal Reserve. The Federal Reserve, it's like a tongue twister, meets this week. They have a 2-day meeting tomorrow, the 15th, and Wednesday, the 16th. At the end of the meeting, which is at 2:00, so around 2:15 or so, you'll see a statement from the Federal Reserve. It'll come across all the major news terminals. If you get alerts on your smartphone, it'll pop up all over your alerts. Federal Reserve raises interest rates a 1/4 point, and that's the big thing, and they could raise rates even more at the next meeting. They expect rates to continue to rise. They'll be data dependent, blah, blah, blah. So you have rising rates, inflation, and that's really what's sucking the value out of tech stocks and the stock market in general. It's not necessarily the Ukraine-Russia war. If there was no energy involved between Ukraine and Russia, and they didn't affect, oil markets, this really wouldn't be that, economically speaking, that big of a deal. And I'm not trying to take away from the human suffering and the loss of life. That not at all. I applaud and I pray for Ukraine. I really like their president too, right? Don't you like the president, Vladimir, right? Zelensky. So this is what we're facing. We're facing a slowing economy, rising inflation, That's called stagflation. It doesn't have to be as bad as it was in the 70s, but it could get as bad as it was in the 70s. It wouldn't be unheard of. Let me make this. There we go. That's better. It could be as bad as the 70s, but things are so open ended and uncertain in terms of what can happen with inflation and interest rates. Will the Fed raise rates too much, too far? Will it take its time? These are the kinds of things that we just don't have a good handle on. And then there's a sudden realization that, you know what, our place in the world is not as secure as we thought. I think a lot of Americans maybe didn't realize how much China and Russia really hate us. Um, I think a lot of people thought we had such a good peaceful globe for the most part for the last 30 years, but we're not really. I mean, we have a major war and refugee crisis in Europe. We just, no one today has ever seen this unless maybe you were very young. I mean, let World War II, but how many people today were around for World War II, and who were old enough to actually remember it? Okay, it's one thing my mother was a World War II era baby, but she was born in 1942. I'm sure she doesn't remember too much about the war. All right, so these are the kinds of things that we face, and this is why the market's been such a rocky place. So I see a comment out there. Let's see who's out there. LinkedIn user, yes. Thank you, LinkedIn user. I appreciate that. I don't remember the exact question. I'm sorry. I have a tendency to ramble a little bit, and I don't remember exactly what I said. But I like the word yes. Yes is a very appealing word in any language. Sí. Okay. See, I said it. Sí in Spanish. Let's take a look at my watch list. All right. Brother, when I pull up stocks or my watch list, whatever, I want you to know you are absolutely always welcome to take a look at what I'm looking at. But I want to show you the sector ETFs. Okay. All right. So XLF, the winners of the day were financials, healthcare, consumer staples, industrials. Mixed bag. Usually, if you see industrials and financials up, you'd see consumer staples down. So there's a bit of a flight to safety. It's tough to say exactly. I mean, I have to look at the individual stocks to see why XLI, that's the big ETF that tracks the industrial sector. But there's 11 sectors, and these are the big ETFs that track them. So I look at these as my proxy to track the sectors of the stock market. At the bottom was energy and technology. This is unusual because we've seen energy at the top of the list of outperformers for so long. It was $80. Now it's 74. So it's not quite a 10% correction, but down to 72 will be at a 10% correction. So that's where things are now. All right. Let's take a look at a few other things. I don't want to make you nauseous by scrolling around so much, but I had a conversation today with an investor who's in a fund that has a lot of these stocks. Look, Apple is down 2.6% from 182 down to 150. That's getting hit pretty hard. Amazon 3,700 to 2,800, down almost 1,000. Facebook at a low. Google right, Alphabet right in the middle. Microsoft more or less in the middle. Nvidia a little bit south of Midland, and Netflix. Right, I don't include Netflix in my spot in this area though, but Netflix hit a year low today, 52-week low, and the stock is literally down to where it was before the whole freaking pandemic. It gave everything back. All right, and that's what we need to talk about. Why would a stock like Netflix give everything back? Could it come back? Could it recover? Yeah, it could recover. Anything can happen. I mean, it could. I think you want more certainty than that, and I'd like to give you that certainty. But these are uncertain times, and I'm not going to make a bold prediction, make a promise that I can't keep. You have to give credit to interest rates and liquidity. When interest rates go down and liquidity goes up, it causes assets to go up in value, like houses and stocks. All right. houses adjust more slowly to up markets and down markets than stocks. So I think people are caught off guard by how quickly the stock market went down and how quickly a lot of stocks like Netflix from $700 a share down to 331. It's really, stunning to see a stock like Netflix go down that much. All right. I don't have a share of it in my book of business, by the way. Just want to throw that out there. Not one share of that stock. Not one share. People looking over my shoulder. Not one share. Yeah, my desk is a little messy. Just ignore this. Got a lot going on here. Okay. So, liquidity. When the Fed lowers interest rates and you don't make anything in the bank on your money, you get nothing for a 1 or 2 or 3, even a 5-year CD, and you're looking to make money, what do? Especially if you're a baby boomer, you put money into stocks that pay dividends. So it forces a flood of money into those kinds of stocks, and those stocks go up. It forces money managers to look beyond what they ordinarily would invest in. So think of liquidity. It makes investors less discerning in terms of what they're willing to own. When liquidity starts to dry up like it is now, it makes investors more discerning. So now they're like, well, I don't want to own any of those meme stocks or SPACs anymore. They're just too risky. I don't want to own much of anything. In fact, the cash I'm holding on to, I just want to hold on to. And before you know it, you have even your largest cap, highest quality stocks, the can't miss stocks, down 30, 40, 50%, and then some. And that's what's going on. When does it end? It might not end for a while. Listen, I've seen the NASDAQ have 50% plus drawdowns in the past. And I've seen the S&P 500 have drawdowns of 50% or more in the past. It can happen. Right now, a lot of things don't look particularly positive, but and you could say, well, they have great earnings, they have growth, but they were projected, their valuations were projected to have even greater earnings than what they're showing now, greater growth rates than what they're showing now. You take that away, you take the stimulus away from the Federal Reserve and from Congress, and what you have is a reason to sell off. You don't have as much buying power going into these stocks. So that's the real reason why they're down. I just want to take a look at this particular mutual fund. Okay. I was talking about it. It looks like it was a pretty popular fund at one point. Let me pop you up in here into the screen here. Okay. I'm going to make this bigger so you could see what I'm looking at. All right. This is the Mainstay Winslow Large Cap Growth Fund. I was looking at it for a friend. All right. And it is down about 21% year to date, which is more or less in line exactly with the NASDAQ. And this has been a really good fund to own. Okay, especially in the last couple of years, it's been a good fund. But look at this, from here down to here, down to here. The fund is just about to where it was before the pandemic. And I'll show you why, because it's filled with pandemic stocks. Okay. Even though the category, can't get rid of that advertisement, but it's large cap growth. Okay. It should just be called the tech fund. All right. Because it's down 21% year to date return. I'm starting to make you nauseous here, but see, it's got Microsoft, Amazon, Alphabet, which is Google, Tesla, more Alphabet, MasterCard, NVIDIA, Meta, which is Facebook, and Adobe and Nike. I mean, these are the hot stocks of the, post of the pandemic and post-pandemic time frame. And those are the stocks that caught a bid. They got really hot. They went up a lot on a wave of liquidity. They had the fundamentals to justify it. They had the liquidity to get investors into them. But now that liquidity seems to be drying up, these stocks are going down and investors are trying to get out of them, which is why these stocks go down every day. And this is why I'm surprised that the NASDAQ is only down about 21%, and the S&P 500 is only down about 10.5% year to date. I'm surprised you're not down more, given the performance of so many large cap stocks. Bank stocks have also taken on the chin. I was looking at JP Morgan. It was in the 150s and 160s for so long, and now it's in the 130s. Just incredible the shellacking that stocks have taken. So if you have a fund or an exchange traded fund or a mutual fund and you're wondering why it's down so much, it probably looks a lot like this fund. These funds just basically went into the hottest, biggest stocks. They all chased them. And now that the chase is over, these stocks are coming down to earth and it's killing the fund's performance. So basically what you did is you bought the NASDAQ with a different name. This one, it's the Mainstay, Investors Growth Fund, Windsor Investor Growth Fund, as opposed to just saying the NASDAQ fund. And that's why you see so many funds getting hit. You have to look at what's inside of it. So the question is, should you buy more of them? That's up to you. For my money, no, I wouldn't buy more necessarily. I would rather buy something different. And so what's a sector to take a look at? An out of favor, beaten up sector. And the only one I could really come up with that never really had the giant rally to begin with, and it's still beaten down, is emerging markets. And I say that because when I look at client portfolios, investor portfolios, like that, new accounts that come into me, into my orbit, my clientele, they don't have emerging markets. It's like people have given up on emerging markets. Anyone that could have, should have, or would have sold out of emerging markets has done so already. And that's one area that I do see value. It takes guts. I mean, if you tell somebody, hey, you should buy emerging markets, like, what are you, an asshole? I'm not going to buy emerging markets. No, that's not the point. It's an out of favor sector. These emerging market countries are not going away. Okay, so what about Russia? Not every emerging market is Russia. Russia was a teeny tiny bit little piece of the MSCI benchmark, the main benchmark that tracks emerging markets. And in the meantime, you have tons of other countries that could do very well, especially with inflationary times, because a lot of emerging markets are suppliers of minerals and iron and other commodities, etc. So this is, the kind of thing that I look for to get into really, really cheap, that I think is oversold. When I look at tech, when people are still looking at like the tech stocks or the the large cap tech stocks, and they still say, oh, these are cheap, I would own them, I would buy more, I would average down, that tells me they're not cheap yet. When we get to the point where people say, I'm not even considering those, or I would sell what I have left of them, that to me is when we're going to be able to say tech is cheap. But as long as people every single day are coming on TV saying, oh, you should own, yeah, you should definitely buy them here, yeah, they're good buys here, that strikes me as like the year 2000, 2001 all over again. And in the great tech wreck, the tech wreck did not end until 2003. There was a 3-year event. And in the Great Recession in 2008, it started in 2009. The market started to go down in 2007, fall of 2007, and it didn't bottom until spring of 2009. So it went on for like a year and a half. All right. So for some reason, people have this thing like, I'll just buy the dip and the market will come right back up and everything will be fine. Doesn't always work that way. In fact, it usually does not work that way. All right. A lot of people thought they were smart out here. Another friend of mine was doing so well. He's like, oh, we should partner up. We should do stuff together. I'm telling you, I'm really good at this. And every day I get a text from him with some weird conspiracy theory as to why his stocks are down. You have to start coming up with weird conspiracy theories as to why your stocks are down. You're really just fighting a losing battle. Anyway, I want to wish you all a good day. Thanks for sticking with me. I hope I helped make sense of some of this. I don't know if it's tomorrow or the next day, but I'm having an oil man on from Texas, a friend of mine who's also traded oil futures on the NYMEX, and he's a real smart individual. He's been my guest in the past, and we'll see if he's coming on tomorrow or the next day, probably Wednesday, because it'll give you a little time to pump it up, get his name out there and build a little, excitement for the show. Okay. I'll speak with you guys tomorrow. Thanks so much.